Hi, and welcome to another executive interview. Today we have Tim Rooney, CEO of Salad Money, a UK-based fintech company that offers affordable credit to key workers. Tim, thank you for joining us today.
No problem. Thanks very much for the time, Rhythm.
Brilliant. Now, Tim, could you provide our audience with a brief overview of Salad Money and the types of customers that you serve?
Sure, thank you. So Salad Money is an FCA regulated lender. We started trading back in May 2019 after seeking approval from the FCA. We lend up to £1,000 to consumers that typically would use high cost credit as a way of getting by. Our average customer, we know this from our stats, is female, 46, 2 children, living in social or private rented accommodation, typically in areas of high deprivation, so areas in the UK like the Northeast, Northwest, Midlands, Scotland and Wales.
Amazing. That's really interesting. It's great to hear that you are helping those who are often underserved by traditional financial institutions. Now, for my next question, it would be great if you could explain how exactly Salad Money's proprietary credit model works, and how would you say that it's different from the traditional credit scoring methods?
Sure. So when we started back in 2018 with the concept, we recognized that open banking at that point in time, could be a very effective way of assessing someone's affordability. And that's a piece that's flown through the business and is still very much part of the business today. So we don't use traditional credit scoring methods at all. We look at people's use and income through the open banking, and on that journey we're able to make much better decisions about their ability to afford and repay the loan. Interestingly, we've taken 30,000 of our customers, 20,000 current customers, 10,000 applicants, and we've run that through a TransUnion retro analysis piece. And interestingly, 10% of the population that we've served do not have a credit footprint. So we're able to reach a lot more customers that typically would be underserved by the high cost credit market. It's also fair to say that in the last 12 to 18 months, a lot of the high cost lenders have left the market due to the number of claims that have been brought against them by the claims management companies for unaffordable lending. Over the 30,000 customers that we've lent to, we've had 3 complaints that have gone to the Financial Ombudsman, and all of those complaints have been rejected by the Financial Ombudsman. And we think it's down to the fact that we use that open banking lens to make credit assessments.
Absolutely. Thank you for explaining that, Tim. Now, how exactly does open banking provide a more accurate assessment of credit worthiness? Could you explain that?
Sure. So the average customer will submit and allow us permission to review up to 18 months worth of their bank account data. So the first thing that we can see is who they're paid by and the stability of their income over time. So we're supplying loans to NHS and key workers within the UK community. And so for us, it's really important that we can see the difference between their fixed income and their disposable income. Any credit commitment that they'll take on will be funded out of that disposable income. So we're very keen to understand how they spend their money and where they spend their money. Open banking is a unique lens on the style and approach that consumers have to their monthly income. So we're able to see, for instance, returned or unpaid direct debits, other unreported credit commitments like council tax that are paid by those individuals, and also the velocity and propensity of spend and the types of things that they're spending on. But overall, I think with the cost of living crisis hitting consumers very hard in the UK, we've been able to see that a buffer needs to be left for those consumers, somewhere in the region of about £200 per month. And our loans typically are about £86 a month. So we feel quite confident that the loans that we're making are affordable and appropriate for that individual. You can see a lot of access to other forms of credit, including buy now, pay later. Buy now, pay later has really worked its way through the system. And we also see things like gambling, online gambling. 29% of our rejected consumers have excessive gambling. And those are things that you would never pick up within a credit score, which is a rather binary and small moment in time that is historically out of date by the time that you're able to consume it.
Absolutely. That's a very great point, Tim. And it's clear that Silent Money is actually leveraging technology to create a very efficient and effective credit assessment process. Now, for my next question, can you tell us how has Silent Money been able to maintain the market leading loss rates and zero upheld FOS complaints?
So one of the things that we did in the beginning of 2022 was to look at how the multiple points, about 4,000 data points per consumer, could be consumed not only by our rules-based credit decisioning, but moving towards a sort of AI stroke machine learning tool. And we call that product Crouton because it's an inherent part of Salad. But we put that into play in August of last year, and that has reduced our losses significantly. We have lifetime losses that are projected now at sub 10%, which for this sector is quite groundbreaking. Typically, you'd be at a 20 or 30% loss rate. So Crouton and the machine learning and the repeat learning that it's getting is proving to be incredibly efficient. And that's the sort of secret sauce that we have, and probably a 2 to 3 year march on our competitors in this space.
That's indeed very impressive. Now, can you speak to us about Silent Money's plans for growth?
Sure. So we started out with the NHS back in 2019, and clearly we lent through COVID and increasingly looked to spread our marketing through natural originations and marketing, but also through brokers. And we've since extended that out to public sector workers. And we're now looking out beyond public sector workers into key workers, people typically in stable long-term employment in manufacturing, banking, finance, etc. We are certainly now the largest CDFI lender in the UK, and we have quite a lot of press and publicity. One of the things that I'm most proud of is the benefit calculator that we put into our loan application journey, where we could help and identify unclaimed benefits for a lot of the customers that come to us looking for those short-term loans. We identified something in the region of in excess of £150 million in the last 12 months, which is way more than we lent. Our growth this time last year, the loan book was at 5 million. Now it's a shade under 19 million. So our growth trajectory is very impressive. And I think it's because we are gaining a reputation. Our Trustpilot reviews are fairly staggering for the size of business that we have, and are worth a read if you'd like to get a sort of feel for who we're serving in the business. But we see the growth as expanding out into the rest of the private sector over time.
That's brilliant. It's very exciting to hear indeed about your ambitious plans for the future. Now, as a parting question, Tim, can you tell us how does Silent Money's diverse range of origination channels and investment in proprietary data and technology support its ability to scale and continuously improve operations?
Sure. So the origination that we have is from brokers and also from our own marketing auspices, but we have referral channels with other CDFI lenders in the UK. The ability to scale is a unique one for us. The Crouton and the machine learning has allowed us to auto accept, auto decline, but also we've got a conscious eye on bias within the system. So we're very keen to understand where our customers come from. And I think typically the view of the credit market was that broker-derived lending always performed at a lower rate than your own directly originated loans. But open banking has laid that bare. And for us, that huge market, as I say, there's a huge chasm that's now appeared with the exit of some of those high-cost lenders, and we see demand increasing on a daily basis. So we think we're set for growth, and we think we have the tools in our kit bag to do that.
That's brilliant. Well, Tim, thank you again for sharing your insights and the work that your team is doing. It's been an enlightening conversation. For those who are interested in learning more, please check out the contact information provided on your screen or in the description of the video. And again, thank you, Tim, for joining me for this interview. And I wish you all the luck with your venture.
Lovely. Thank you so much.
Thank you.
Thank you.